Gentlemen, welcome back. You're back with MGTOW Money. Today's topic is going to be an boring investment you should own. Before we get to that, if you're new to this channel, this of course is MGTOW Money, the only MGTOW channel dedicated to your money, how to make money, how to invest it, and how to spend it more wisely. And maybe, just maybe, you might be able to retire early. On to today's topic, a boring investment you need to own. The investment I'm talking about is bonds. This is the second part of a three-part series on the basics of stocks, bonds, mutual funds will be the third part, and I'll also be talking about ETFs in that third part. This, of course, just like the one I did on stocks, is the very basics of bonds. This is not, I emphasize, this is not some sort of in-depth, comprehensive discussion about bonds. This is the 20% that will provide you the 80% of knowledge that you need to know about bonds. Let's first define what we're talking about bonds, and they might also be called debentures. That's an old term. A bond, a debenture, it's an IOU. That's what it is. It's a loan. It's where money is loaned from you, an individual investor, to a government or a corporation. So you become a creditor to that government or to that corporation. That could be to the U.S. government, that could be to the Australian government, that could be to the European Union, that could be to the Zimbabwean government, that could be to the North Korean government, that could be to ExxonMobil, that could be to BHP Billiton, that could be to Freeport McMoran. In other words, corporations, governments, etc., they're looking to borrow money. You buy a bond from them. Investing in bonds compared to stocks. Investing in bonds is about as exciting as watching the grass grow. Unlike stocks, which sort of have a roller coaster feel to them in the sense of you can have wild swings in the prices. You can double, triple, quadruple your money based upon some of the charts that I showed you in stocks. You know, stocks can move 5, 10, 20% in a day or two. Bonds do not do that. A wild day in the bond market would be if it moves 0.5% or even 1%. So in other words, bonds are not volatile. They're very, very stable. They're very, very smooth. They're not sensitive to short-term moves. Yes, over the long term, bond prices do move. They do go up. They do go down over the long term, and you can certainly make money over the long term if you're on the right side in terms of you've bought a bond at a low price, it's risen in price. It's not uncommon that you can make money, but again, you're holding it for probably years to do so. And of course, it can go the other direction. It can deappreciate and it can fall in value on you. But again, these are long-term type things, generally speaking. The three basics you need to know about all bonds when you're looking at individual bonds, we're not talking about bond funds in this case. Again, we'll talk about that in a future video. We're talking about buying individual bonds, and you purchase it through your stockbroker, just like you've purchased a stock, you purchase a bond through your stockbroker. The three things you need to know are, number one, the term. In other words, the duration or the length of the bond. It could be as short as 90 days, or they actually have some bonds that are issued that are 100 years. So you can purchase a wide variety of bonds in terms of the duration. Typically, at least in the United States, the bonds will range from 90 days to 30 years. So, and by the way, in the United States, I know many of you are interested in the United States markets. They have bills, notes, and bonds. Bills being those short-term instruments, notes being the intermediate-term instruments, let's say 2, 3, 5, 7-year instruments. And then we're talking about 10-year up to 30-year. Those are known as bonds. Again, these terms will vary from country to country, but the concepts remain just the same. In the UK, they're called gilts, G-I-L-T-S. I know in Australia, they're just referred to as bonds, but of course they do have treasury bills there as well. The point being, you just need to know the duration. The second point you need to know is the coupon or the interest rate that the bond is providing to you. The very short-term bills, short-term bonds, if you will, are going to provide a low, very low in today's world interest rate. In other words, they may only provide to you on a 90-day or even a 1-year bond 0.5% on your interest. However, you can be very secure as we can be of anything in the world, that, hey, at least I'll get the money back. If I lend the government $1,000 today, in 1 year, I'll get that $1,000 back, plus I'll get the interest payment. At least on a nominal basis, I can feel secure I'll get it. Same thing again with most corporations. I emphasize most. You loan them $1,000 today for a 1-year period, you're going to get all your money back plus interest. The third part of the bond that you've got to know is something I've already alluded to. Who is the issuer? The government or a corporation? And number two, in particular with corporations, I won't go into this much detail, but just be aware of the credit quality or credit worthiness of the corporation. Just like individuals have a credit score, in other words, some people have a high credit score, corporations do too. Some have an investment grade rating, some do not have an investment grade rating. When you hear about those types of corporations that do not have an investment grade rating, you might hear the term high yield bond. You might also hear the term junk bond. That doesn't mean these bonds are junk literally. That doesn't mean it's something that you should be afraid of and not buy them. You just need to be aware that they are more risky. In other words, a corporation that is non-investment grade is wanting to borrow money from you and from other investors, and they're willing, though, to offer a higher interest rate to do so. So it is a little bit more risky, but you can, just like anything else, make money with them. As I mentioned, you need to be aware that bond prices do go up and down. However, by holding to maturity, when you buy an individual bond, let's say a 1-year bond, a 5-year bond, a 10-year bond, if you hold it to maturity, you put up your $1,000, it has a 5-year duration, you hold it that entire 5 years, you will get presumably, your $1,000 investment back. Plus, of course, in the meantime, you've been paid interest for doing so during that entire period. So you have preserved 100% of your capital, and you've made a nice little income in the meantime. Be aware, however, bond prices are affected by interest rates. I won't go into a major discussion on interest rates. Just be aware, in simple terms, as interest rates increase, generally speaking, bond rates decrease. And as interest rates decrease, in other words, fall, bond rates, bond prices, bond values increase. So interest rates and bond values typically run inverse. They're running inversely. They're going in opposite directions. It's like on a teeter-totter. So just be aware that, again, if you're buying bonds in an interest rate environment where rates are going up, you can be potentially, emphasize that word, potentially hurt. In other words, you might end up losing some money if you don't hold it all the way to its maturity. On the other hand, if you're buying bonds in an interest rate environment where interest rates are falling, you can do very, very well. Let's just take a quick example, and this is all on a long-term basis. Back in the early 1980s in the United States, Treasury bonds, 30-year Treasury bonds, had an interest rate, a coupon rate of 15%, 1.5, amazingly high interest rates. If you had the foresight to purchase at that time and held them for that 30 years, you would, of course, been paid 15% on your money, which is phenomenal. I mean, absolutely unbelievable. Furthermore, as interest rates have fallen since the 1980s, going all the way down to where we are today in the low 2 range on those same bonds, you would have made unbelievable capital gains. So you would have made a capital gain, and you would have been paid a great interest rate on, frankly, a relatively safe, conservative investment. So again, bonds can be a terrific, terrific investment. Putting together an important investment portfolio is like a recipe. You've got multiple ingredients. I won't go, again, into all the details of putting together an investment portfolio. I'll do that in a future video. However, bonds need to be a percentage of any investor's investment portfolio. Just like you might own stocks, just like you might own cryptocurrencies, just like you might have some real estate, just like you might own let's say you have a wine collection that's increasing in value, or you have a gun collection that's increasing in value. You need to have some percentage of your investment portfolio in bonds. I don't care if you're 25 or 75. Having 20 to 25% of your investment allocation of your overall investment portfolio in bonds is a reasonable idea. To sum up, bonds are kind of like, Aesop's fable, the tortoise and the hare in this case being comparable to stocks. Bonds are like the tortoise. They just kind of plod along nice and slowly. They're unlikely to win the race all the time, but you know what? They're going to get you to the finish line. They're unlikely to go to zero, extremely unlikely actually. They're about as close as you can get to what would be called a risk-free investment. In the United States, for example, as well as I know several other respective governments offer inflation-adjusted bonds. In the United States, these are called TIPS. You might also have the availability to purchase I bonds. These bonds are about as safe as anything in the universe that you can possibly get in terms of a risk-free investment. However, just like anything else, the interest rates, unfortunately, are very, very, very low on these particular instruments. I want to give a couple of warnings, though, about bonds. As I mentioned before, just be aware bonds can fluctuate in price, in particular if you don't hold to the duration of the bond. So in other words, I buy a 5-year bond, I need to feel that I'm going to be prepared to hold this bond the entire 5 years because, of course, it can go down in value during that 5 years if I'm not careful, and I could end up losing a portion of my principal. Number 2, be careful. Be aware if you hear about high-yield bonds, junk bonds, or just any sort of investment where they're talking about bonds and they're talking about what seems like a typically high interest rate in today's environment. 6%, 7%, 8%, you need to question, you need to ask specifically, are these junk bonds? What risk do I need to be aware of from the issuer? These are important questions that you, the individual investor, need to ask whenever someone's discussing with you a potential investment in bonds. Gentlemen, as always, I want to thank you for listening. We, of course, are building an international MGTOW army of financially independent men. And because we're moving this forward, I'm going to need your help today. I need you to share this video with friends. I need you to post it on forums. I need you to hit the like button if you found the content useful and hit the subscribe button if you haven't already. As always, John Galt out.